Welcome to another Maine SBDC webinar. My name is Kelsey Reardon and I'm with the state office, and today we have another Maine SBDC state office business advisor with us, Susan Desgrosseilliers, which I believe is how you say it, although she might have to.
Yeah, you did great. That's perfect.
Oh,
yeah.
Great. See, I'm learning.
Pretty close.
Okay. It's always funny. We've all been remote for so long. Many of us are just met in person for the first time a few weeks ago. So we're still learning to pronounce each other's names, even though we've been coworkers for years.
Mm-hmm.
So welcome. If you are not familiar with the Maine SBDC, we are the Small Business Development Centers, and we are here to help with whatever small business needs you may have. We provide no cost to you confidential business advising, and if we can't answer your question, we can certainly connect you with someone who can. Today, we are going over how to prepare to sell your business. So it seems that this is a long process, and so you want to make sure that you are prepared and you're looking to the future. So we'll be going over things to keep in mind. I believe both of our presenters today have owned their own business, and I know Susan has sold and started many businesses at this point, so they have some really great hands-on experience with this exact thing. If you have any questions along the way, feel free to plug those into the chat. Additionally, I'll be sending out a follow-up email later today, which will include the presentation and a link to the recording. So you can rewind and go find your answers, or you can also email me any question you have. Any of the emails that you've gotten from me, you can respond to, and it'll end up in the same place. We're going to ask that you stay muted throughout the presentation, but there'll be plenty of time for Q&A at the end. So we know that sometimes these questions can be a bit complex, and so we may be able to unmute and go get a little more specific during that section. Otherwise, I'm going to pass it over to Susan, who will get us started and introduce our guest speaker.
Great. Well, welcome. I want to warn you in advance, if I am turning my head, I have two screens, and I think my camera's here, but I'm also looking at this screen. So just so you know, if that gets a bit annoying. Welcome to our webinar on selling your business. I will just start with a little bit about what we do at the SBDC, just to kind of add on to what Kelsey mentioned. So we provide one-on-one advising, and the biggest thing, it's confidential, anything we talk about, and also there's no charge whatsoever. And we can work on any number of topics. If you're looking to just start up a business, I know this one is about selling a business, but to be honest with you, when I started my business, I already was thinking about selling it. So there you go. We also work with business planning, financing, helping you put together your loan applications, the financial analysis, your marketing, sales, anything to do with employees or management. That's just kind of a small little, we pretty much touch everything with having to do with business, whether you're a startup or an existing business. And we do have advisors throughout the state. I put that there's 13, but I think there's more than that. I think I need to update this, but Kelsey could tell me, but basically there's someone in your area for sure. So my name is Susan. As Kelsey mentioned, I have been a small business owner for over 30 years, owned several businesses, one of which I started from nothing and sold about 5 years ago, I guess now. I also have background in marketing and design and economic development, which is kind of a weird combination, but it's Maine, and that's how we work here, right? We're kind of doing a little bit of everything. Certified business advisor. I also have a lot of experience in real estate management, having owned a business with multiple properties that I developed and along with my former partner. And leased and or sold, and then also I'm a licensed Maine real estate broker. And we're really lucky to have Brian Hanson with us. Brian is the president and owner of Maine Business Brokers. and which focuses on the sell side brokerage firm based here in Maine and also businesses in New Hampshire. He has been a business broker for over 15 years. He's also a licensed designated broker. And he's a multiple business owner. And it says on your screen here with decades of entrepreneurial experience, and I can speak having gone to college with Brian and remember him owning a business way back then. Actually, it wasn't that far ago, right, Brian? But I'm really psyched that we have him because he is very, very experienced. And I think you guys are going to get a lot out of his input. Now, with that being said, you're going to be stuck listening to me for a little bit. I'm going to kind of run through the presentation. And as Kelsey mentioned, please put your questions in the chat box. But, you know, it's pretty loose. There's not a right or wrong here. And if it's something that needs to be addressed as we're going through, we can do that, but we can always circle back. So let's get started. So the first thing that I think you want to look at is why are you selling, and you really want to consider timing, right? So when you go to sell your business, one of the things that a potential buyer is going to be very interested in is why are you selling, right? And you want to have your story straight, and it really should be a story, right? You want to create that sense of awe. You want to entice these buyers to buy your business because it's profitable, number one. It's interesting, it's exciting. So, you know, what happens when we've owned a business for a long time, to many of us business owners, is we do kind of get burned out, right? When I sold my business, I really was ready to sell, but I had to be very careful about, I didn't want to convey that I was burnt out, bored, tired, ready to move on, right? I had to be still very excited about my business. And with that being said, I ended up selling it to an employee. So you can imagine how that all played out, having to be excited, but I was excited to sell and still had to remain excited about the business as well. But anyways, so some of the most common reasons that owners decide to sell is they want to retire, right? That's a good story. That makes sense. Sometimes there's a dispute with a partnership that could even be a spouse. A lot of family-owned businesses in Maine. So I didn't list it on here, but divorce is a huge one. Obviously, if somebody gets sick, or they're just overworked or bored, that is okay to communicate, but you still need to make sure that you can communicate it in a way that really boosts your business up. It's just your personal, you know, you started this baby, it means so much to you, but you're ready to move on, right? So that's really important when you go to sell, is to sit back and think, why am I getting out now, right? You don't want the answer to be because the business is tanking, right? Because nobody's going to buy it. So think about that. Okay, so some timing. You want to, I don't know if this is showing up here or not. You want to be prepared as far in advance as possible. You know, I think Brian can speak to this too, but well, to all of this, but on the timing, you definitely want to think as far out in advance as you can. And again, in my own experience, I tried to do that specifically because, as we'll look at a little later on in the presentation, I had some owner's discretionary expenses that I was kind of running through the business, which were legal from a tax standpoint, but it also affected what my bottom line looked like, which was fine for taxes, right? But when I wanted to sell the business, I really needed to show that really good cash flow that was actually there in the business all along. So you want to prepare for that, and you can't just do it, you know, 6 months or a year before you want to sell. So you really want to plan a couple of years out so you can start to make those transitions ahead of time so that they will then show up in your tax returns, right? Your business tax returns, and then your financial records as well, which this slide says, you know, allows times for you to improve your financial records. Also improve your business structure, right? So if you've got some challenges with a process or vendors or an employee or something like that, if you can work those out and have a nice little package with a bow on top when you go to sell that business, you know, you're going to be in a much better position to get what that business is really worth. So you want to try to improve any of those little things that are a nuisance now, but they're only a nuisance because you've just been living with them. But you don't want to pass those on to a new business owner if you can help it, because you're going to have to disclose that. It's going to come up somewhere. You could use the time to improve any customer relations. That's always really, really great to do at any time. But, you know, again, starting that as far back as possible. And then, like what I did, it gives you time to groom a buyer, especially from within your organization, you know, especially a smaller business. Oftentimes there is somebody that's sitting right in your office or out driving one of the trucks, you know, or doing something that has the ability that you see that could be the next potential business owner, and that won't happen overnight, right? So if they are someone that's working in your office and they're responsible for one area of the business, you want to take that time to start exposing them to some of the other things that they're not doing yet, and really start to get them ready so that in your mind, so that if they were going to take it over, they would be experienced in those other areas, and they would also feel that they could do it. Something really important that I didn't have on the slide originally that Brian brought to my attention, which definitely makes sense, which I thought about, is the tax implications. So there are definitely tax implications on selling your business, when you sell it, how you structure that, whether it's going to be an asset sale or there's a lot of goodwill. So that is really, I have to tell you, that's really, really good advice, because that is one thing that I did do, as well as I met with my accountant well in advance. And I was then able to structure the deal that was the most beneficial for myself as the seller. It wasn't the best deal for the buyer, but it was the best deal for me as a seller. So there's a lot of things that you can do in structuring it that's really important. And then keep your eye on the ball. Just because you're ready to exit doesn't mean that you're going to sit back and, you know, let things just kind of go with the flow. You really want to keep your eye on the ball and make sure that that business is growing, that your profits remain where they were or higher. Your list of clients and customers is strong. So it's very important, and it's hard when you're starting to think about selling to not want to kind of start to take a step back and let things kind of go. Okay, so you're ready to go. There's a number of things you've decided, okay, I'm ready to go for whatever your reason is. And maybe that's why you're here today, because you're starting to think about it. So there's some things that you want to focus on. One is sprucing up the business, which we'll talk about. We're talking about each of these. Getting a professional business valuation so that you know your business is priced right. And Brian will talk more about that as well. Getting your books in order. Figure out how profitable your business really is. And that's what I was alluding to or mentioning when I talked about the owner's discretionary expenses. And then getting your team assembled to kind of help you make that transition. So we'll start with sprucing up. You know, obviously, if it's a brick and mortar, you want to make that a great first impression. Or if you're working out of an office, same thing. I mean, you want, when some potential buyer comes into your space, no matter what it is, you want to look organized. You want the space to look clean. You want it to look inviting, whether they're going to take that space over or not. It's very important that their first impression is the best that it can be. That means you want to repair or replace anything that you've been dealing with, right? We all have those things in our businesses that we just kind of dealt with because we're the owner, and, you know, it's just how it's been. But there are some things that don't cost a lot of money that you've just dealt with that you want to take the time to repair or replace or whatever you need to do. Organize. Get your paperwork all in order. And that doesn't just mean the papers on your desk, because my desk looks kind of messy right now. That means everything from your legal, like leases or any agreements you have with partnerships or whatever. Make sure everything is up to date and organized. If you have written an employee manual, it's a good time to take a look at that, or an employee handbook is a good time to take a look at that. Any procedural manuals that you might have written for your business, you know, if they're just kind of on paper somewhere, make them look nice, put them in a nice little binder, because all of this is going to be things that a buyer is going to look at. And it goes a long way if you make that first impression the best you can. You make the buyer feel like this is something that I could step into and take over. I'm not going to have to get in here and try to figure everything out. Also review your website. We all know how easy it is to create that website and then we kind of leave it. It gets outdated. That also is a place that you can often make some improvements on that don't cost a lot of money, but update some images, upload some of your latest projects with clients or whatever it is that you're doing for business. Okay, so get a professional business valuation. And Brian did scold me on this. Brian, you can jump in any moment. And he did remind me, he's like, Sue, they're so expensive, number one. They're hard to get because there aren't a lot of companies or firms that are really interested in doing business valuations, especially here in our state. Oftentimes what a business owner does is, and as an SBDC advisor, I've seen this many times, is I'll meet with a client. They'll say, Susan, I'm getting ready to sell my business. I met with my accountant. She went over this and this is what it's worth. And then I start looking at it and I'm like, how did she come up with that, right? If you are going to work with your accountant or an accounting firm, make sure that they are proficient in business valuation. Just because they're an accountant or somebody who's been doing your book work for years does not mean that they have the tools and the skills that it takes to really do a proper business valuation. And there's several ways to value a business, which we're not going to get really in depth in today because we have another webinar where we've already done that, which Kelsey can point everybody to if you want to go back and take a look at that. I also listed business brokers, which Brian is a business broker. And as he pointed out, many business brokers don't really want to provide them unless you're going to list your business with you, and or they may fluff it up a bit so that you will list with them. So you have to just be really cautious and do a lot of homework and due diligence during the process of finding someone to do the business valuation. SBDC advisors, we can help you with that. We do have tools, although we will walk you through it using the information that you provide to us. We are not in any way going to tell you that this is the number you should be selling for. We're not going there, but we can help you prepare. There's a lot that you need to do to get the books in shape to enable a firm, an accountant, a business broker to be able to look at what you have and help determine what the value of that business is. Brian, anything you want to throw in there?
Yeah, let me comment on that. I'm also getting an echo.
Oh.
Why is that?
It doesn't sound like it from my end. Do you hear that, Kelsey? No.
Yeah, that was a little strange.
There was also a question from someone. You want to address that first, Susan?
I didn't even see it. Go for it. What is?
Yeah, so we had, I believe Judy she's wanting to sell their Airbnb and was wondering if it would be better to sell as a business or as a real estate. It's 2 acres of shorefront plus another 4, so I assume acres. What capital gains would be different, or would capital gains be different?
Yes and yes. Yeah. I'll let Brian, I'll just add my 2 cents in and then let Brian add his $100 bills in. What I would say is figure out the best way that you can structure it, right? So is the property worth more just as the property sits? I mean, it's waterfront, and in this market, it may not even, somebody may not even be interested in it as a B&B. And if you kind of put yourself in that keyhole, in that peg, then that's what you're going to be marketing as a B&B. You're going to limit yourself to the potential buyer pool, right? Knowing what the real estate market is, I don't know where your property is, but if it's waterfront, that's going to have a whole lot of value, and probably more value than what a B&B business could support in terms of mortgage and financing and all of that. Okay, Brian?
Yeah, no, I agree with that. And this is this sort of touches upon a major issue that we're seeing in general, and that is many long-term businesses where the business owner owns the real estate. They may be in a position where the highest and best use for that property doesn't support the current business. So, for example, a family owns a seafood restaurant in Bar Harbor, and they've owned it for 50 or 60 years. That piece of property may be worth multiple millions of dollars, and the business itself, if they look at exiting or selling it, that current business model may not be able to support the mortgage on that real estate. right? So they have a choice of either selling the business and maybe taking a lower market amount on the lease, or just closing the business and selling the real estate because the real estate market is so hot. So we're seeing a real disparity between real estate values and in business operations. So in this case, I think you touched upon it, Susan. If you sell it as a business, the value is going to be driven by the income that it produces. And in this real estate market, the reality is finding the highest and best use is probably going to be easier just listing it as a piece of real estate.
Right. And one other thing that I'll add to that is, it's not one size fits all. Now, in this particular case, that might be the best, but you may own a piece of real estate that you operate the business out of. And you may decide to do it in 2 steps, right? To help the potential buyer. You may decide, okay, so what we're going to do is I'm going to sell you the business. I'm going to retain the property, and you're going to lease from me. And then in 4 years down the road, you're going to then buy the real estate. And you don't even have to, or I'm going to give you the option to buy this real estate. And what that does is it allows the buyer, they don't have to come up with a whole bunch of money up front for the business and the real estate. You're breaking it. And then it also helps you on capital gains, because you're not paying capital gains on everything at once. It helps, time value of money. It spreads that out a bit. So there's a lot of ways that you can structure a sale of a business. There isn't just one size fits all.
Susan, let me touch on something else. We're talking about business value in relation to selling your business. But the reality is that many, many business owners that I encounter who aren't ready to sell yet have no idea what their business is worth. And you think about that, everybody knows what they have for a loan on their car. They know what the value of their house is. If they have investments, they know, you can, in a second, they can cite the value of almost everything they own. And yet most business owners don't know the value of the business, which could represent majority of their net worth.
Mm-hmm.
And so understanding how you value your business is a tool that you're going to use throughout the life as a business owner, right? Because you may know the value of your business now, but it may not be at the value that you need to sell it to either do something else or retire. So there's a roadmap process. So not only are you trying to prepare when you eventually sell, there's things you can do to prepare your business for sale. There may be things you need to do to your business to get it to the value that you need. And whether that's through growth or eliminating some debt or reconfiguring your business model, it's important that you know where you are now and where you have to be when you eventually want to exit that business.
Yeah, that's great advice. And that goes right back to timing and planning as far ahead as you can, because that'll allow you to do all of these things or start working on all of them. Thank you. Okay, so another thing that is you have to have is you'll be asked to provide information on your business, right? So whether we call it a seller's packet or whatever, I just say, let's get your books in order, right? You're going to obviously need to have current financial statements, right? Your P&L, your balance sheet. So you want to make sure that if there's anything you need to clean up on the balance sheet, that's been done, because oftentimes there are things that need to be taken care of. So make sure you take care of all of that before any of this is shown. They're going to want your business tax returns, usually 3 years minimum on the business tax returns. And then one thing I often meet with clients about, and they haven't done this, which surprises me, is they don't have a current list of their equipment and or inventory that they're going to include in the sale, which when you think about it should really be on part of the balance sheet. But let's be real, oftentimes there's some differences between what might actually be on your balance sheet to what might be a whole list of your equipment and inventory, which is a whole nother reason to get that situated and taken care of ahead of time, because ideally you want those numbers to pretty much match with depreciation, everything of course considered. So there's a lot of equipment to consider, or there could be, that you're going to sell with the property or with the business. And sometimes it's, just the customer list or whatever it is. You just need to know what it is that you're going to be selling and have a nice list put together that is reflective of the current market value, and then also reflects on your balance sheet. It's also important to have a good list of contacts together. Anything that's related to the sales of your service or product, and then also your suppliers. I always taught people that worked for me that our suppliers were as important as our customers, and I treated them that way, and they treated me like gold back, and they were there for me while I went through the selling process. They helped me make it so much easier to transition from myself as the owner to a new owner, because I had a really strong relationship with them. So that's very important, that you really keep a very strong, healthy relationship with your suppliers. And ones that you don't have a healthy relationship with, move on. Take care of that ahead of time. And then any current leases, which I had mentioned before, which comes down to even like the copier, right? Sometimes people will rent a copy machine or lease a copy machine. It's got like 5 years on it, and you're only 2 years into it, and you're going to sell it. So you want to find out how that all will shake out ahead of time. Anything else, Brian, you think they might want to?
Yeah, I have two items. So it seems kind of obvious, but it's often overlooked, and it can kill a deal. And that is what is not included in the sale.
Good point.
So sometimes a business may use, the owner may have a truck that's used to go pick up supplies or make a delivery or plow the parking lot, but that's the owner's personal vehicle. So if there is an asset that really isn't going to be transferred in the sale, but has a legitimate business use, it needs to be replaced or addressed, and not at the day of closing. That's a surprise no one wants. I recently sold a business where all of the wall art, the decorations, and it was a significant amount of it, was the owner's personal art collection.
Yeah.
And so at the sale, the new owner, the buyer, had to, I think it was almost $20,000 to redecorate the business. They knew about it ahead of time, but it was still a little bit of an issue, right? Because that just adds a significant amount of cost of the acquisition. So what's excluded needs, maybe the laptop or the computer that the owner uses, they want to take with them because all their personal files are on it too. But if that's sort of the server for a POS system or something, that needs to be addressed. It could be a small thing, it could be a large thing, but it should be identified early on in the process.
That's a great point.
The second thing I want to talk about, you mentioned leases. So there's equipment leases. Those are what we call third-party consents. So oftentimes there is another person that will get to decide whether you can sell your business or not. It can be frustrating. And one of the biggest items that we're seeing now, especially in Portland on the peninsula, are leases that aren't really transferable. So more and more landlords are putting in stricter language that says if there is a material change of ownership, then the landlord reserves the right to renegotiate the lease. So that can be a surprise to a lot of people. If that lease doesn't have what's typically we see as ordinate language where the lease can be transferred with the owner's permission and it can't be unreasonably withheld, something like that. So as long as the new owner is financially qualified, then generally the landlord is going to allow that lease to be transferred. But we're seeing less and less of that. And we're talking about situations where leases or rent amounts can double. So if there is a lease, you should really see if it's transferable. And if it isn't, you might want to get a better sense of what the landlord would be looking for or what current market rates are, because it could make your business unsaleable. There's probably not a week that goes by that I don't talk to a business in the Old Port that is basically they can't sell because it will trigger a lease negotiation and the rent rate will double. And that current business wouldn't be able to support that rent.
So what's the way you work around that, Brian? Do you suggest that the would-be seller goes out and tries to find an alternative space, and then how do they get out of their existing lease? That's a real challenge.
I mean, there's no space available, and relocating a business is a whole. Yeah. You could do a whole workshop on that.
Right.
No, so if you are thinking about selling, once you identify a buyer, you probably need to have the conversation with your landlord sooner rather than later. And if the landlord says no, or he says it's going to, the rent's going to double, then at least you'll know sooner rather than later before either the buyer or seller incurs costs, whether it's legal or time.
Right. So again, it's all about time and relationships, figuring out well ahead of time what some of these issues are, what they could be, and trying to figure out a way to deal with them ahead of time. Yeah, that's excellent. Okay, so again, looking at the profitability of your business, I've mentioned it twice already, because as being a small business owner, I was very familiar with SDE, which is seller's discretionary expense. There's also seller's discretionary income, but we're talking about expenses right now, which are really non-operational expenses, which would affect the bottom line of the P&L, also cash flow. So just to mention some of the things that come to mind are, if there's a personal auto lease, the owner's medical and/or life insurance, any personal travel. I don't want to say that I ever took any trips that were business and then extended them a little bit personally and expense that through the business. I'm not saying I did that. I'm just saying that maybe that could happen. And that includes some meals, maybe some toilet paper and paper towels for your house. I mean, it sounds silly, but the things that we can run through the business really do add up. The memberships, like, oh, I have to have that golf membership so that I can play with clients, and really, yeah. Home landscaping. I mean, there's all kinds of things. Your landscape, you're buying some plants for your business, and then you might add a few in for your home or things like that. Just saying that can happen. Do you agree with that, Brian?
I see it every day. So, owning a small business, there's lots of risks involved, but one of the benefits of being a small business owner, there's a gray area there, and most business owners run some discretionary expenses through the operation.
Mm-hmm.
But it's important for a business owner to identify those. For a couple of reasons, but one, it's going to improve the bottom line of your business, which will then drive the value of your business up.
Right.
And then on the buy side, it's important that they know what these costs are, because they want a clear look at the business, right? And so these discretionary expenses distort the business performance.
Mm-hmm.
And so the seller needs to identify them and say, look, once you own this business, this family trip is gone, this personal is gone, and all of that. That gives them a better look at the business to assess it.
Absolutely. And, and that's again why you want to prepare ahead of time, because you don't want to just the year before you decide to sell, start running those expenses through the business. You want to show a history. You want to show, 2 or 3 years if you can, by pulling the SDE out of the business, so that your P&L, your profit and loss statement, your tax returns, all of that looks better to the buyer, shows more cash, and your profit is higher as well. So it's important to identify those well in advance so that you can start to make adjustments. All right. Getting your team assembled, very important. You don't have to have a huge team, but you definitely want to talk with your accountant, like we already talked about earlier, and that was on the valuation side. But you want to talk with your accountant about what your tax position would be, your liability would be, because maybe it's not the right time for you to sell because you have something else going on that will affect your tax return for that year, and maybe you want to hold off a year. You also want to make sure that you talk to an attorney when you've got any leases or anything that you're looking at, something like Brian mentioned. Make sure your attorney is proficient in selling a business and potentially could help you. She or he could help you negotiate some of those lease issues or other things that you have going on, or if you have partners or what have you. It's always a good idea to talk to a business broker. And if Brian were not here, I would still say that they, have their pulse on the business community, what the buyers are like out there, and what potential buyer might be interested in your business, as well as, of course, helping you on that valuation side, or at least giving you a real good look at what you've come up with and help you be realistic about that. And then I say talk with your vendors, and then I say shh, because it's hard. Like when you go to sell your business, you don't want everyone to know, right? You don't want your customers to know. Half the time, you don't want your employees to know. You don't want to get your vendors upset, or it's a hard thing. But again, if you have that team that you've assembled from day one even, but even as far back as you can, and that would include your vendors as part of your team. I mean, I talked openly with two of my big vendors about the fact that I was getting ready to sell. And I did it for a couple of reasons. One, I knew that I had their confidence, I had their confidentiality without having them sign a confidentiality agreement. I just had a really good relationship with them. I wanted to see what their take was on the pulse of the market, because these vendors are involved in all kinds of competitor businesses, right? So they know how your competitors are doing, and they may not share that specific information, but they're a wealth of knowledge. And then also it helps them prepare, to know that you're going to sell, and that you're going to bring on a new owner, and that you want to be helpful in that process so that they can maintain and develop a good relationship with these vendors that you've been working with for years. And then it's really important that you think about how you can help that new owner succeed, right? It's nice to think that you get to the closing, you get your check, and then you're out of there, right? That isn't always the case. And more often than not, the previous owner will still be involved in the business even after it's sold. And that comes down to a few things, like how vital are you to the business? And maybe is it a little too much, right? So again, I'll use myself as an example. When I was getting ready to sell my business, and as I mentioned, I identified a buyer internally, I started to put her out in the face of my clients, and I started giving her more exposure and pulling myself back so that it wasn't, we need to talk to Susan, right? I have to talk to Susan about this. I need Susan's, but I wanted the clients, the vendors, the public to start to see me a little less and to see her a little more, right? Because I thought that I would still have some, I would be involved slightly with the business after selling, but just mostly with the transition. But I really, really wanted her to be successful. And it's almost hard to say that, right? Like, oh my God, is she going to be more successful than I was with the business? Well, I hope so, because that means that I built a really good foundation, right? And she's the next generation to take that on. So one of the things you can do is set up a succession plan for the buyer, right? So that they have someone to turn to. It doesn't have to be you, but oftentimes it is, and it's really what your level of comfort is. And I really want to hear what Brian has to say about this. And then when do you want to do that? You want to develop that succession plan before going to market, right? Because it can be a really good selling point to be able to say either, I'm going to be here at this capacity, you'll be able to reach out to me, whatever it is. Or if it's a really complicated sale or the business is complicated and it really feels like it's necessary that you transition with the business for 3 months or 2 months or 30 days or whatever it is, that you've identified that, figured it out, which makes it so much easier for the buyer when they're looking at purchasing. And other times it might be just keep your hands off, right? Seller, just sell me the business and step back. But it depends on the type of business and what you have going on. What do you think about that, Brian?
Well, I'll talk in generalities here. Typically, the seller provides some level of free transitional training. It's sort of included in the price. Depending on the complexity of the business, on average, it's usually 2, 3, maybe 4 weeks of full-time work, maybe a couple more weeks of part-time, and then after that, just be available by phone, for consulting. And that's typically negotiated as part of the whole structure of the deal, and it's put into the purchase and sale. But my experience has been that buyers always ask for more transitional training and support than they ever end up using. Because once they take over the business and feel a little bit comfortable, they don't really want the previous owner there.
Right.
So for me, it's a good negotiating point because it's easy to agree to excessive transition and training because I know they're not ever really going to be able to provide it. And it makes the buyer feel comfortable knowing that you will be there for them post-closing.
If they need you. That's great. That's a really good point.
Yeah. So in cases where the owner has an oversized presence, maybe they're not working in the business, but you sort of keep them on the masthead So, as an elder statesman or a consultant or something, so customers, vendors, and everybody can look at that business and say, Susan's still involved, or Susan's there in some capacity, and that makes me feel more comfortable about the transition.
Mhm.
Right?
And making those introductions, making the introductions from to the new owner, to the vendors, to the customers and clients, that can be very valuable for a new business owner. And also it helps the relationship with the clients, the customers, and or the vendors as well, because you're taking the time to introduce this new buyer. You feel really good about them, hopefully. So it starts that relationship with you still involved and being very easy to step out once the introductions have been made and set up.
Good.
So that pretty much covers the presentation part. And now we wanted to leave a good amount of time for questions. So Kelsey, do we have any questions?
All right. Well, thank you both. There are no current questions, so everyone rush to the chat right now and plug those in. I did find the previous Selling a Business webinar that we did all the way back in 2020, which now feels like
wow. I thought it was like, just a few
I know. I was
ago.
like, hey, we just did that recently. And that's with Rainer Large, who's now at CEI, although he was at AvCog when he did the presentation. And that, if you are familiar with Rainer, he's our numbers guy. So that session goes a little bit more into those numbers. So I'll include that link in my follow-up email. He also talks a lot about the succession plan and how important that is. And one of my biggest takeaways from that session was he brings up a good point. As a small business owner, you probably work a tremendous amount and possibly 24 hours a day sometimes. And so you should probably start scheduling some time off and figure out what you're going to do when suddenly you have all this free time on your hands and you're floundering looking for something to fill your time. So make sure you're being gentle with yourself as well throughout all of this. A couple questions came in. Anne, I see you're unmuted. Do you want to go ahead first?
Sure. Hi, everybody. Hi, Brian. Hi, Susan.
Hi.
Kelsey. Brian, well, I don't know the answer to this question. So recently coming back to Maine and starting with the SBDC right before COVID, I learned that real estate brokers can represent both sellers and buyers. Can business brokers represent both, and how often does that happen?
It happens very little. There's only a handful of business brokers that work on the buy side. We work on the buy side for large, highly qualified individuals or corporations or companies. The problem is, and it occurs in real estate, but it's generally overlooked, there's a real conflict of interest. If I am a buyer broker and I'm representing you and you're looking for a business, I am incentivized by two things. One is that you buy a business, and many people should not buy a business, I would add, but I need you to buy a business and I get paid more the more you spend. And personally, I find that ethically challenging. So I stay away from that side of it. When we do work on the buy side for companies, we get paid by them. So I'm getting paid by the client I represent, not getting paid on the other side in a co-broke situation that's common and typical in real estate.
Okay, but if by law in Maine, can you do both? Because again, I agree with you. I agree with you on the conflict of interest. I mean, that to me, absolutely, I was just astounded with real estate that could happen. Right.
So when there's real estate involved, we fall under real estate law and regulation. When there's no real estate, it's a fairly unregulated industry. So there are business brokers out there that don't have any type of licensing, even real estate, even though by law they're required to, especially even if they're negotiating a lease interest, you need to be a licensed real estate agent. So it's sort of an overlooked and ignored part of it. It's a little bit of a Wild West out there, but there's just not a lot of practitioners anyway. There's not a lot of business brokers in Maine or New England in general.
Right. And that was my next question. How many business brokers are there? Because I only know you.
Right. There's probably 3 or 4 firms. Some of those are one-person operations. There's some large business brokerage franchise systems that people are connected to. They come in with policies and procedures and processes. But generally, it's small. there's not a lot of deal flow. At any given point, there's only about 250 businesses listed in the state of Maine, about the same in New Hampshire. Right now, it's half that number. Just like real estate, there's not a lot of businesses on the market. And out of that, let's call it 250, half of them are probably unsaleable. They're either a broken or business that's heading towards bankruptcy or closure, or it's just too small and it doesn't really provide any level of profitability.
You answered my next question. Okay, thank you.
Sure.
Great.
That's a good question.
We had a couple questions there too.
Yep. So Abigail saying, what sort of help can buyers provide in terms of financing? My business will need to be taken over by someone relatively young with a lot of energy, and they feel that a person like this might not have access to financing.
Well, a huge percentage, which Brian might have the percentage figured out, but a huge percentage of sales of business result in the seller holding some paper. In my own case, I held it twice. I held it in the initial sale of the business, which again was obviously very beneficial to the buyer because it allowed them to, with my holding paper, doing some of the financing, it allowed them to get the additional bank financing that they need because it spread the risk between the bank and myself and the new buyer. And then I also held paper on the actual real estate end as well. And it can be a real bonus to the seller because you're going to make interest on the money. You're going to spread out the capital gains that you're going to have to pay on that money. Obviously, it's a risk. But you want to do your due diligence on the buyer as well, right? To make sure that just as one of the participants is saying, it's going to need a lot of energy. Well, make sure that buyer has a lot of energy, right? And also dig into their finances, especially if you're going to be holding some paper, obviously. So it's very, very common that the seller will hold some paper or help with the financing themselves on the sale of a business. And a bank really likes to see that as well. Brian, what do you think?
I would agree with that. I think we see seller financing in virtually every deal now. As you mentioned, it sends a great signal to the bank. It's saying that the seller is confident in the business that they're selling. Sometimes that seller financing can actually meet down payment requirements that the buyer needs for financing. But generally, when we talk about seller financing, we're not talking about 50, 60, 70, 80% of the deal. It's typically 15 to 25%. So the seller has a stake in it as well. So they're sharing some risk. But there's also, I want to sort of tie into young people getting financing. There was a question about that. There are programs through the SBA where the SBA and the government comes in and guarantees loans the banks can make. And when there's that liquidity in programs out on the market, it really can help young people obtain financing for a business purchase.
And one of the questions I see, I think it's from Abigail, is do businesses lend money for people to buy businesses? Yes, they do every day. And that is one of the things that Ann, myself, other SBDC advisors work on every single day, helping our clients at no charge, by the way, and confidentially put together a package, loan package or a loan application, which would include your written business plan. This is from the buyer now, a written business plan, as well as the financial projections, which would include some historicals that you would get from the seller of the business. So yes, and the banks look at this, similar same things that they would if you were buying a piece of real estate. That's the easiest way to use the example that most of us understand, and that's credit. You have to have good credit. Collateral, you need to have collateral, and the business has to cash flow. It has to be able to support the debt of the bank, and also if there is owner financing for that as well. So we help our clients put that together. So if any of you as business owners are putting your business up for sale, you can meet with us, right, to help you through that process to get all your ducks in a row. And then also, if you have a buyer that you've identified, you can refer that buyer to the SBDC as well, and we can help that buyer prepare their package to purchase a business as well.
Yeah, and we actually, oops, sorry to interrupt you.
Are we out of time? No, I was going to add 2 points, but I can wait.
Yeah. I was just going to say, we have a new business advisor at AvCog, and she comes to us from her background is in bank lending. So she just did a webinar about bank loan applications and what the bank looks for from that side. So that's a really good one that's on our YouTube. But go ahead, Brian. Then we have another.
Yeah, I just want to address sort of two misconceptions that I see a lot. And the first one is that unlike automobiles and mortgages, you can't really get pre-approved for a business loan.
No.
You might, so when someone shows up and says, I'm pre-approved for up to $500,000, what the bank's really told them is that they're credit worthy and they would certainly take a look at it. But until they get a chance to look at the business and the tax returns and everything else, they can't guarantee that loan. It's just not a blanket credit worthiness up to $500,000. So they can just go out and start shopping for a business that fits that range. So I see that quite a lot. The second one is these government programs like the SBA will tend to guarantee 90% of the loan amount that the bank lends the buyer. But what people often think is that they hear that and they assume that all they need is 10% of the purchase price and the rest of it will be financed through the SBA. It doesn't work that way. So typically banks are going to finance 80% of the purchase price. And out of that 80%, SBA, if it meets SBA requirements, will guarantee 90% of that note. So it's somewhere around 65% of the entire deal. So when a buyer approaches you and says, I've got 10% down, or I've got 100,000, I'm looking for $1 million business to purchase, they're probably not going to meet those lending requirements.
Mm-hmm.
So we do have two questions from Dan. The first one, which I misread at the beginning, I thought he was asking how to sell his children, but he was wondering how can you sell a business to your children? And then the follow-up to that is, are sales proceeds to the seller generally considered ordinary income, long-term capital gains, or some other category?
Combination. And that's how you structure the deal, right? So if you're selling assets, it's going to be taxed one way. If you're selling goodwill, it's going to be taxed another way. Even the inventory is looked at differently. So again, it's very important to meet with your accountant ahead of time. I'm telling you, I structured mine knowing the best way that the tax situation or position would be for myself, because I had that meeting well in advance. Ryan?
Yeah. So we could do a deep dive into taxable events of the sale, but a lot of this falls under, Dan, what's called allocation. So when a price is agreed upon, then we take the assets of the business and assign them to different asset categories, like goodwill that's amortized, or FF&E, fixtures, furniture, equipment that are depreciated off. So there's a lot of taxable event here. Here's the problem, and Susan sort of touched upon it. The buyer and the seller are adversarial in this. What is good for the seller may not be for the buyer. And if you have a sophisticated buyer, or you have a buyer that has sophisticated advisors, there's going to be a whole nother negotiation. In larger deals that I do, the allocation of the deal is more important than the price that's being paid, because it taxes so much, and it can also kill a deal. That needs to be addressed early. Almost always, as a seller, you want to be taxed at long-term capital gains. That's the lowest rate. It's 15% federal and 7 or 8% on the state level. That's going to be your lowest tax rate. But the buyer is going to push back. They don't want goodwill, because goodwill gets amortized over 17 to 23 years. So it's not what we call a very effective tax shield for the buyer. So without getting too much into it, there is a separate negotiation there beyond just price and terms that can have an impact on how the deal is structured.
And so how does that play in when you're selling to your kid? If you're trying to protect yourself, but also your children's future, that sounds very complicated.
So I would ask Dan, is this a friendly transaction? And when I mean friendly, like you are able or willing to do a price concession, or take all seller financing, or gift some of the value of the business over time. And you have huge advantages to do a transaction like that within a family. But if it's arm's length, meaning you come up with a fair market value of the business and your children purchase it like any other buyer, then you're sort of left with all the same negotiations that a traditional transaction would have.
And yeah, Dan, feel free to take over.
No, excellent question, answers to all of those questions. And I was really thinking more in just general terms. And I guess I was a little more concerned about the pitfalls of selling to multiple children. I wasn't real clear on the question. Not so much anything about the price, but just if you're selling a business that's a good business to your kids because you think it's something they would benefit from, what might you be aware of as the parent/seller?
Well,
That's a big one.
it opens up a
Huge
whole can
question,
of
and
worms.
it may be beyond the scope of this podcast.
Well,
Yeah,
there's so many variables. I mean, are they working in the business now? And if they are, what are their roles and how will that allocate or be changed when you change hands?
Right.
You know,
Do they want the business, Dan?
I think so.
see, mine didn't. That was the thing, is my two daughters did not. So I thought, okay, so they're out. You know, they both had their own careers.
Easy.
Yes. Yeah.
We're seeing that family transition, Dan, less and less. You know, children, they go to college outside of the state, or they move, they start families or lives somewhere else, and they just aren't motivated to come back and take over the family business. And it's been a real source of frustration for a lot of my clients who has spent their whole life with the expectation that their next generation would continue with the family business, and to find out that no, they don't want it. You know, and they might find that out later in life, where now they don't have a lot of time to sort of prepare the business for a third party buyer, right? They have to start from scratch. The other issues, and Susan asked a good question, are they in the business? You know, sometimes if the children are also working in the business or have worked, one may have a oversized role over the other, and then it's really tricky on ownership percentages and the value contribution that a child might have given to the business over time. And if you have any kind of rivalries that all children might have, it can really open up some family dynamics that can be awkward, at least awkward, and worse.
Another thing I would recommend too is I'm familiar with several successful family-owned businesses that did transition. If you can, and because they're family business and you're setting up this you have this family business, oftentimes they can be a really good resource to talk to others that have gone through that process, because they're going to be able to point out some of the things that really worked and didn't work. And I've also found them to be very willing to share their stories, because I mean, as business owners, we love to talk about our business, right? And we love to talk about our family. And I mean, there's some things that maybe they're not going to want to share, but if you can pinpoint and reach out to any other long-standing, you know, I'm thinking of a couple of lumber companies, there's a bunch of them out there across the state that might be a good resource for you.
Thank you.
And yes, thanks, Anne.
Yeah, and Dan, make sure you check in the chat. Anne is another wonderful Maine SBDC business advisor. She mentioned the Institute for Family-Owned Business organization would be a great resource. Thanks, Anne.
Good. Thank you.
Awesome. I don't see any other questions. We did get a bunch of thank yous. Other people had to jump off, but this was wonderful.
Great. Well, thank you. Thank you, Brian.
You're welcome. Thank
Really
you.
appreciate your time. Okay.
Yeah, we appreciate everyone's time. Thank you to the presenters. Thank you to all of our viewers. I will send out all my follow-up information later this afternoon. And like I said, feel free to respond to any of those emails if you have any future questions. Otherwise, we hope we'll see you at the next event.
Okay. Thank you.
Thank you.
Bye, guys.